Welcome back to Colombia, to all of you actually. At a time when there's a bit of uncertainty at the national level. Let's call it the policy pendulum swinging back hard, to put it mildly. I know this is the most loaded question I can ask, but OBBBA, the One Big Beautiful Bill Act. Would anyone like to get us started on what is the impact in very real terms? And thank you. So actually, maybe let me say 2 more sentences once you give a prof the mic so they will just talk. So we've done a bit of an analysis. And okay, so busy slide. I'll let you critique the slide at a different time. But when we look at this, right, so obviously, right, offshore wind is dead. Because, right, they turned whales gay or something. Sorry, Patty is the formal presidential quote. And then there are some other technologies which one could argue now have literally 100% bipartisan consensus. Right? First it was a purely Democratic bill, and now a purely Republican bill. 100 senators, plus minus a couple, who vote for geothermal, carbon capture, nuclear, certain kind of energy storage subsidies that are now enshrined into law, at least for that decade, starting at August 22 when the Inflation Reduction Act was passed. And with that as a backdrop, maybe, back to the question, how do you view, Preeti, if we start with you, how do you as a sizable financial institutional investor look at the federal level right now and make any decisions whatsoever, given the uncertainties?
Yeah, it's a great question. First of all, you stole the headline, which is, number one, I think it's important to remember that clean energy is not a monolith. I think if you read a lot of the headlines right now, they act like all of the clean energy subsectors are dead. And the fact of the matter is, there are subsectors. And if you do your job as an investor and dig in, you can find the opportunities where they lie. So to your point, offshore wind is having a rough time right now, to put it lightly. And we all knew that was coming. The signals were there from the get-go. You can have similar conversations around solar, some of these other renewable energies. But when you look at battery technology, biofuels, carbon capture, to your point, nuclear, we can have a whole conversation about nuclear. There's still some interesting tailwinds we're seeing in the space. Mm-hmm. And so throwing the baby out with the bathwater, I don't think is how any good investor operates in the first place, number one. Number two, like any investor, I go back to fundamentals. And when I think about my fundamentals, 2 things are true. Number one, the unit economics of renewables are still in play. So in most of the world, solar is cheaper than coal. You're probably sick of hearing that. You hear it a lot because it's true. And so regardless of what's happening from a policy standpoint, subsidy or non-subsidy, you're looking at a world increasingly where renewable is just without argument the cheapest form of new energy. And new energy is not even going to be a question in a world where AI is sucking up every electron we can send it. And so in a world where we have not just energy transition, but energy addition, we need to be adding more energy to the grid. There's no question that renewables being the cheapest means it's going to be part of the conversation, number one. Number two, the US isn't the only party in town. So certainly US policy matters, but don't forget that you have the Green New Deal in Europe, you have EV subsidies in China, you have microgrid technology in India, we can all talk about nuclear in France. I mean, there's a big, wide world out there. And so when you think about policy, you can't just focus on the United States. And the last thing I'll say is, again, at the risk of being too much of an investor, to some extent, I think it's easy to get caught up in the conversation about policy, but a lot of the conversation is really about interest rates. And so a lot of the time, some of my students are sitting here. One of the assumptions a lot of students make coming into my room is that renewables definitely did better under Biden than they did under Trump's first administration. And when you look at the actual financial performance of renewable ETFs, it's actually the opposite. Renewables did way better under Trump 1 than under Biden. Why is that? It had nothing to do with policy. It was purely an interest rate play. Interest rates were low under Trump 1. And interest rates got higher under Biden for a variety of reasons. And so renewables moved conversely. So just keep in mind your fundamentals, the unit economics of renewables, the interest rate play, the global policy piece. I think it makes for actually a much more mixed, if not optimistic picture than some of these charts would suggest.
I'll jump in with, I love that you moved to a little bit more of a macro strategy, kind of looking at the macro backdrop, which is to say you can talk about interest rates with OB3, which we will potentially more
I like
seamlessly
that
refer
better
to it
than
as. I think it's important to be cognizant of this move towards more transactional economic policy rather than a stable multi-year discussion. And a huge example of that is tariff wars. And I bring up the tariff wars because there is no climate investor who is not also thinking about the tariffs on aluminum, copper, and steel, because all of that goes into, and all of that's part of the value chain for EVs, for an energy transition. And when we look at, M&A transactions, there has been cautious growth, and it only happened after May when the tariffs started to shake out and different countries found their loopholes to get better tariff rates. So I think that's an important backdrop, even thinking about OB3 at a federal level. There have been, I actually love this slide because it really sheds light. Sheds light on where there's some pain. The IRA had a huge push for green hydrogen through OSED, so the Office of Clean Energy Development, and that's really gotten hit. There was an announcement out of California just a few days ago where allocation of something like 1.2 billion just got cut, and they are no longer allocating that. This is, again, now you're seeing at a federal level down to a state level, this much more transactional conversation around these policies. And we can and should go into, I loved Preeti's point about the nuance here and how it's, we can still have an energy transition. We're just cognizant of, again, this move to transactional negotiations and that we are playing on a global playing field. So, we could have been, owning the value chain for green hydrogen. It seems like that's not going to be our play. And, competition will come in from other countries, but I'll pause there.
Cool. Marieke, I'll bring you into the conversation in a minute, but so I like how you mentioned tariffs. So I don't like tariffs necessarily, but, and to Preeti's point, solar PV tariffs are not a Trump invention, turns out. We've had those since pre-Trump.
Yes.
Not to the extent, but maybe can you say a couple more words about that?
I think that the Trump administration, it's interesting because we're no longer seeing the reaction to tariff announcements. We're no longer seeing the market reaction to tariff announcements in terms of valuations, but when earnings reports continue to come out and we're expecting to kind of have the rubber hit the road end of Q4 2025 and then into 2026, and particularly hitting metals and mining by about 8% across that industry, autos, and so including EVs. And so these elements where, again, you've got these steel, aluminum, and copper all have now 15% tariffs on them. So it's not new, but the dynamic of those conversations have changed. And so, I think it's been ramped up.
Marieke, OB3.
Yes.
Big picture.
Yeah, so we're only private capital.
Oh my God.
It is not. You may need to turn it on.
How about that?
Yes.
That sounds better.
Much better.
Troubleshooting.
Climate tech.
I wasn't trying to say something quietly so that nobody could hear me. No, so yeah, we're a network of a trade association of only private capital impact funds, right? And about 40% of them are in investing in environment sustainability. So they've got theoretically a lot of exposure to these types of changes. I guess my first, in one word, you might think oof, right? But actually it's a recalibration. We see it sort of as a kind of a recalibration. And, we have most of the managers in our network are 10-year funds. Some of them are evergreen. And they don't tend to, it's a more patient, right? It's a more patient approach. And they've never really designed an impact investing thesis that underwrites to sort of binary policy outcomes. So and also climate investing is not monolithic, as Preeti mentioned, right? Mm-hmm. That said, also, right, our investors are not immune to some of what a non-impact, non-climate investor might be affected by, right? So tariffs or interest rates or things like that, right? So it's really a recalibration. So we see it as, yeah, they're the mix of winners and losers, if you will, or the carrots and sticks has changed a little bit, right? So we see more interest in geothermal, perhaps, right, or CCS, so carbon capture storage, energy storage, and optimization there. Wind definitely affected, right? Solar to some extent as well. But we always knew that these things were going to phase out, right? Tax credits were going to phase out. It was a matter of time. And so we see an accelerated track. So depending on what you're investing in and how diversified you are in that strategy or niche you are, you may have more or less exposure. But again, most of our investors are thinking ahead and have a pretty long time frame. And yeah, it's I wouldn't say oof to recalibration to maybe cautious optimism. At least there's some certainty, right? Now that we know that particular shoe has dropped, right? The OB3 happened, and now we can start to think about where do we go from here.
I just pulled on this thread of recalibration because I think it's absolutely brilliant. And part of it is just a reminder of where we kind of are in the hype cycle and market of climate tech as well. Regardless of what's happening in the administration, the fact of the matter is, I think clean tech and green tech was kind of all the rage for a minute. It was a frothy market. That's not unique to our space. That's true of any market. Let's all look at Bitcoin for a minute. So when you have something that comes in and kind of captures a lot of public opinion and captures a lot of excitement, inevitably there's going to be froth in that market, and then that froth will clear. In this moment, the froth happened to clear where in a moment of policy transition as well, but I don't want to overly conflate those moments. I don't think the end of the kind of green hype cycle is necessarily directly correlated to policy changes. It's in part just a natural thing that markets do when the tourists come in and then the tourists clear out.
And one other thing, Marieke, I loved your point on seeking certainty. Businesses love certainty, particularly when you're in industries where a life cycle for a project is 10 to 15 years out. That was, part of the reason why capital allocators were kind of paralyzed in the first quarter of the year, because we were talking about, at one point, 300% tariffs. That was insane. But the kind of like search for certainty, it's interesting, and Preeti had brought up this global policy that we're looking to, particularly on energy transition. What a recent roundtable that I attended really came to, in terms of the head of the conversation, is this idea of, okay, in terms of corporate strategy, how are companies thinking about their, decarbonization of their operations for their, how is that extended to their M&A? How is it extending to their, acquisitions or sale of assets? And then on top of that, how is it then transitioning to their CFO vertical? So how are they hedging their risk to carbon pricing globally? And that holy trinity of the seamlessness of a decarbonization strategy really through those multiple verticals of a company, we're not there yet, but that I think is where we're moving to, and companies are really going to kind of able to get more juice out of this approach, thinking about it competitively as a competitive advantage by finding those synergies within their organization. So that's, in terms of like the light at the end of the tunnel, I think that's for global companies in particular, yeah.
So picking up on that, right? Yeah. Global, at the end of the day, where the CO2 comes from or where it is abated, doesn't matter to the climate. China, for the very first time, has an absolute emissions target ever, right? Biggest news in many ways coming out of Climate Week.
And price on carbon?
Yes, there are basically, right? There are reasons to believe that while we are taking steps in a certain direction, others are pressing ahead. Can you just give us a big picture, right? So China, yes, going in one direction, and frankly, only one direction. Europe, India, Brazil, anyone want to piece up the occupy one of the continents, or tell us, basically, where would you be looking for maybe positive surprises?
I think the efforts to onshore and nearshore make Latin America, Brazil, South America, this kind of geographical region quite interesting in terms of...
Because of the US? Because we are...
Because if you're looking for kind of like the goals of different companies and kind of incentives that onshore, owning your supply chain and having it be more geographically local, I think that's an interesting opportunity there. And the other thing that I think is going to be a really big push, we are expecting, everything that touches energy transition as well as defense to grow, particularly in Europe and APAC. Japan and Germany both changed laws that allows them to expand those industries and change kind of how they can issue debt, which all pull from mining. And so I see that there's kind of going to be growth there, and some, and as much as you can overlay those industries, I think there'll be.
So Latin America, good.
Yeah.
China, India?
I can add some bright spots, and rather than think of them as entire markets, I'll drill into some specifics. Raise your hand if you've sat in a Chinese EV, or ideally even driven one. Yeah, they are comfy. And so when you think about the tech, and I mean that sincerely, like, let's just say it, like BYD went from being, unfortunately, a punchline at these conferences 5 years ago to having a real, viable vehicle that, by the way, is doing very well in the British market, which is one of the only Western markets that didn't tariff them out. And so I don't know what that means for that specific stock, but I do think it's an indicator of what it means when the Chinese government decides to back a particular form of clean tech. And so these are the moments where I think, especially in the EV space, regardless of what's happening here in the United States, frankly, the US isn't the most relevant market. When you think about India, for example, you have folks, you have EV companies that are trying to penetrate the Indian market with 1.5 billion people. And most of them, by the way, aren't, unlike BYD, inventing new technology. They're just taking pre-existing technology and scaling it in a market with, again, 1.5 billion people. And so these scaling plays, especially as you start to look at private equity, these middle market plays that are not the early VC kind of really sexy clean tech stuff we were talking about a few years ago, they're taking pre-existing technology and just scaling it in emerging markets, I think is really interesting. So that's on the EV side. I'm almost hesitant to say nuclear in France is like a boring story now. It's so blasé. Of course the French grid now is so dominated by the nuclear conversation. That's not even news. That was old news back when I was sitting in your seats 10 years ago. And so is there a question about whether or not you can build a grid on nuclear? That's not even a question anymore. Those models already exist. And then back to India for a moment. Again, we've been talking about microgrid forever. For a long time, the story, when I was growing up, the story was, there are these remote last mile communities in India that just aren't on the grid. And because of that, they were able to leapfrog and create microgrid technology, which actually arguably is even more resilient than some of the aging traditional grid technology we have here in the United States. So, you can go region by region, country by country, and find those bright spots. And again, when you're talking about markets of billions of people, the actual investment opportunity suddenly opens up really broadly.
Now, you reminded us before, just because the technology is on the winning side doesn't mean that it's a good investment. Right? So, don't ask economists for investment advice. I think that's a universal thing. But, okay, PV, solar PV, winning technology, LONGi, one of the top 3 or so leading companies, plus 1,200% or so to its peak, minus 90%. And no, not because of OB3, not because of anything else.
No, it's just because of retail, because people are buying in. It's like with solar, it's very interesting because, people are effectively voting on that with their dollars. But it's not, the margins are slim.
Because the panels are so cheap, Germans are installing them as garden fences, so you can't make any money producing them.
Exactly. But in terms of the margins for solar are low, and so in terms of like a PE play, it's harder. It's just not as lucrative. So it's consistent, but the margins are just lower.
Well, and it's a reminder about timeline. Yeah. As an investor, one of the most important questions is, what's your timeline? And so if you buy into technology that you think is fundamentally good and you're really disappointed the stock didn't go up tomorrow, guess what? You don't know how investing works. And so part of the question becomes, what is your timeline? And I work with thousands of clients. I have very different timelines. And so I don't have a monolithic answer for all of them. If you're investing in order to pay your kids' tuition in September, guess what? You have one investment profile. If you're investing intergenerationally, as a lot of the sustainability-oriented clients that I work with do, they're looking at intergenerational plays. They're looking at wealth transfer. They're looking at long-term endowments. And for them, the question isn't, will this stock go up tomorrow or next week or even 4 years from now? It's, what will this play look like 20 years from now, 100 years from now? And so much of this boils down to what's the timeline you're looking at and what is your thesis along that timeline.
Yeah, and it was in May, I think, so it was just after a bunch of tariffs had gone live. I was speaking with a handful of European pensions, and we were supposed to talk about AI, and the conversation quickly changed to tariffs, as they are universal holders, and we're trying to understand what their exposure was. And this is a group that is extremely interested in the energy transition and making sure that their grid is transitioning and they have control, the energy independence given what's going on with Russia. And so their approach to it was, we want to get a vertical slice, which is to say, if we want exposure to nuclear, then we want a vertical slice of that, which is to say all of the different investment vehicles that we can get exposure to, we want a full vertical slice of it, which I just thought was a uniquely European, I hadn't heard that before, approach to getting exposure to a theme. But to your point, this idea of we have a 100-year time horizon, this is just, we're universal holders, we have to have exposure everywhere, we want to know where they're going to be winners and losers, but we can't divest kind of thing.
And some of that, just really quickly, just want to add, like some of that is also cultural differences as well, right?
Yeah.
Look at Japan, people thinking about 1,000 years, right? Like thinking back for sort of, what your ancestors were thinking about and like what you're going to be leaving in 1,000 years' time, or many, many generations forward. And sort of having large pension funds, from the allocator perspective, which you can perhaps speak to more than I can, Preeti, but like they have a mandate, they have capital, they need to deploy, and so they're looking outside of Japan, right, in that case, or so they're looking at the U.S. and there may be attractive assets or projects in the United States where perhaps U.S.-based allocators may not be going in, where Europeans might come in, and we do see pension funds in Europe sort of actually being more stringent, right, or saying actually, if you backtrack too much, U.S. funds, like will be out of our mix, right? So it's not all, we're seeing, a shift there too.
It'll be interesting to see with the U.S. and,
No, I'll get
with the U.S. and growth. So there are two, I know we're moving towards deregulation in terms of like the EPA, and there's potentially now moving from quarterly to semi-annual reporting. The SEC is no longer going to do the, ESG-themed disclosures. California still has their bills that came out for public and private companies that are set to go live in 2026 for climate disclosures, which it will be interesting to see kind of how that comes to fruition. And they just announced carbon markets established through 2045. So these are all things that are confidence-inspiring and impact an insane number of companies, particularly on the private market side, well beyond the SEC. So
I do want to expand the conversation, but before I do that, may I put you on the spot one last time? So, capital for good. Can you point to examples where capital is in fact pushing in the wrong direction? Or for that matter, where it's technology for good, right? And by good I mean climate in this case, right? So we're trying to cut CO2 emissions, or suck it back out after the fact, or whatever it is. Somehow figure out the climate impact per dollar spent, invested. There are better and worse technologies, and I guess what I'm fishing for is, where do we need policy to guide us in the right direction, versus where are we, in solar PV and Texas territory, where, used to be that California was ahead, no longer the case. And by the way, that wasn't Biden, right? IRA affects both California and Texas equally, for the most part. Are there technologies where you say, okay, and that's very good for the climate, but unless we subsidize, or unless we price carbon, or unless something happens, we just won't get there?
I think what's going on in mining is a tough spot. So for rare earth minerals and critical minerals, China really has kind of like a lock on processing those minerals. So no matter where they are mined, they have to go through China, and then they get sold throughout the supply chain. There was a push in the US to have small and mid-sized processing facilities, and I think that those are like 10, 15-year projects. I think,
So mining in the US,
not mining, it's the processing of it. Because we're trying to do mining in the US right now.
Okay.
with the new administration. But it's the processing of, if we can't own that or have a bigger footprint in there, I think we've lost that game.
I'm going to give you a cheeky answer, but I mean it sincerely. When you ask kind of what's the tech that needs support, there's a lot of conversation about carbon capture, and understandably, because somebody's got to suck that carbon out of the air. And as many of you probably know, there are kind of two forms of carbon capture. There's mechanical, which is all of the really expensive kind of moonshots that VC is trying to fund right now and figure out how on earth to do that efficiently at the scale we need. But then there's natural, because you know who's really good at sucking carbon out of the air? Trees. And so there's this entire body of work around nature-based solutions and natural carbon capture. And it's one of those markets that kind of every once in a while blips up in interest. And part of the reason it usually fizzles back out is because nobody's really aced, well, how do you give credit to trees for sucking carbon out of the air? There was a carbon credit market, and it frothed, and then it collapsed, and verifiability and accountability, and John Oliver did a segment saying carbon credits are bad, and so everybody kind of went south on them. So it's one of those markets that keeps frothing up and dissipating, but when you think about the scale of the carbon challenge we have, unless you're looking at oceans and trees and mangroves and kelp, and we can get into all of the really technicalities. By the way, beavers do amazing things when it comes to carbon capture. Unless we're actually really having those conversations, we can't achieve any of what we need to achieve at scale, and it's going to require more coherent policy to get us to a rationalized place around that work.
Really quickly, and I loved everything that's been said, I would say, it's the additionality piece, right? Figuring that out. So maybe it's not so much about what particular technology, but really understanding that, right? And so that we don't veer into just, financial engineering as well, right? So we're actually mitigating and abating. I think, right, we're seeing people move into, private capital investors moving into resilience and adaptation. And so when we talk about policy, right, the hope is there is a role. We need to also talk about actual mitigation, conservation, right? I don't know how many of you here have seen the Apple TV series Extrapolations, right? There are plenty of impact investors who will make some serious coin off of addressing the symptoms, right? And the outcomes from the road that we're on, right? We think about 180 billion in losses by insurers in 2024 alone from climate-related disasters. So this is, people are gonna find a way to address this without, those are the fundamentals, those are, market dynamics, but I do think there is a role for sort of trying to address the more root causes of some of this as well.
So are we going back to your Dutch roots now and saying that some countries are actually getting it right? Or, are there examples, right? Is Northern Europe, Tata Steel, Netherlands, right, is turning its operations around fully over the next less than 10 years at this point, 7 years, I believe, in part, right, local, national, and European support, which is needed. And yeah, the Europeans are doing it, we are currently not. Who is doing it better than us, than the US?
So I will defend the US and say, it's not usually a position I find myself in. Even the US market isn't, again, I keep saying, this is my mantra today, it's not a monolith. So when you think about the US market, you have institutional investors, you have pensions, you have insurance companies, you have family offices, you have foundations, you have endowments, you have retail investors, you've got a wide array of investors. And I will tell you, as somebody who works very closely with kind of a diverse investor base, high net worths are really stepping in right now. US-based high net worths and ultra high net worths, so very wealthy people and family offices, are very active in the space, even if they're domiciled here in the United States, in part because many of them see this as their moment to enter into the market, either because they have an impact imperative to do so, or because, back to frothy valuations, they were like, hey, you remember all those securities that were way too overpriced 2 years ago? I want in on them now. And so I wouldn't assume the entire US market is kind of out of the game. I actually think family offices and high net worths are stepping in this moment because they have the capital to do so, and they have the sophisticated office who've been doing this kind of value analysis anyway.
JPM Chase Private Bank, right?
Correct.
Okay, just checking. I think it's time for Q&A, but Marieke.
Oh no, I was just gonna say +1 to all of that. Sort of exciting family offices coming in and doing, addressing that missing middle space, which we need, the growth equity space in particular.
I'm going to kick off our Q&A with a quick one. So on the topic of carbon capture and storage, curious as to what extent you all think that the enhanced oil approach and kind of sending it back into the earth is viable and really stands any chance of being useful versus other approaches to carbon capture and storage.
Can't be the only one. I think that's my big. I know Occidental has made a huge push into this with Vicky at the helm there, but it's, I think we should be cognizant of that as a solution, yeah. I think with anything, a huge takeaway for me during Climate Week was durability of strategies and defensibility, and in that comes diversification, so it just can't be the only one.
Questions. And let me just say very quickly, that was a perfect example. Question is one sentence long, ends with a question mark. And please introduce yourself.
Hi, my name is Alfredo Espinosa. I'm an alum of Columbia Business School. I would like to ask Preeti to go a bit deeper on her observation about the importance of natural sinks such as oceans and forests, and how we can better compensate the people that are stewarding those resources, because I think that we're a long ways from having cost-competitive capture sucking technologies in the next 5-10 years. Thank you.
Yeah, I don't have a silver bullet here, but I'll talk to you about a couple models we've seen. Model number one, we'll talk about land and sea. On the land side, I think the ideal state, the Socratic ideal, is one in which people are compensated to keep trees living on their property rather than lumbering. Like, that's the fundamental question. Most people who are landowners who own forestry, for example, they don't make any money unless they cut those trees down and sell them. That's the basic economics of land ownership, typically. And so how do you actually make sure that those people are better compensated for keeping the trees living than for cutting those trees down? Like, that's the fundamental economic question. And so that's where things like carbon credits come into play. Now, the carbon credit market, as you probably know, has been floated largely by all of the companies, and by which I mean really all of the companies that have made net zero commitments by 2030 or 2050, usually 2030, because most of those companies can't actually meet those net zero commitments without carbon credits. And so you have this really interesting market where you have a bunch of companies who are basically trying to buy carbon credits. You have a bunch of people who are like, I would love to be paid to not cut trees down. And so there's some matchmaking to be done in the market at the most fundamental level. Now, there are a lot of ways in which that matchmaking hasn't worked and has had fraud and all kinds of problems which we can get into, but at its pure sense, that's kind of a land-based market option. On the ocean side, there are actually these really interesting blue bonds that some people in the room have probably read about or probably even participated in. So Barbados has done really interesting conservation work around this, where Barbados said, look, we happen to steward some of the most ecologically important ecosystems in the world, especially when you think about the coral reefs that they have access to. But they pointed out that the debt financing, the students in my class are going to hear this for the second time, the debt financing on their sovereign debt is so expensive, they don't have a penny to be able to put towards some of the conservation efforts they want to put in place. And so one of the really interesting innovations they did was they went to a series of high net worths, by the way, to refinance their sovereign debt at lower levels, agreeing to commit that delta to marine conservation. And so really interesting opportunity. The high net worths came to the table specifically because they like the idea of marine conservation. So one land-based, one sea-based, there are 1,000 other examples of that out in the market. And again, many of them haven't worked historically, but not because they can't, just because they haven't.
And I would just add one thing. The blue bond, what was beautiful about the blue bonds is they have grown like significantly, mostly because the green bond had this established framework, and then anyway, it just grew the blue bond market, which was fantastic. The other thing I will say about carbon markets, which is quite interesting, is in the next 3 years, 2 years, there's a huge drop in supply, so that it definitely has had its ups and downs, but that is just, they're set to, by 2030, I think, double the price of carbon pricing, particularly in Europe, but elsewhere as well.
Going to pile on carbon markets?
No.
Okay. Question.
Hi, quick question on politics, because I feel there's been a lot of debate about the amazing or whatever bill this is, but I want to focus on global politics.
I got a bias already, but go ahead.
No, I was sarcastic, but it's fine. Let's say I am an Indian politician. What advice would you give to me or any developing country's politician to make your life easier? How can we contribute to this climate crisis or like make this better?
How can you provide the policy environment that may be lacking here?
Yeah, like what can we do as the next generation of politicians to help deal with this crisis?
You like the US, Preeti, so I won't pick on you right now. Okay. Bridget.
For me, I think it's I just went to a fund that was focusing on cooling India, so I'll focus on India for the second. But this idea of local projects, kind of grassroots projects, and aggregating it in line with a national policy to cool, because so many people are dying during inclement weather, particularly heat, and how to, and this is, just how to basically like bring in fans and natural cooling and all, their structural piece with infrastructure and urban planning. But what was incredible about it, and I talked about this earlier, is this idea of having multiple facets working together. I think from an investor perspective, and even, I mean, I can't speak to diplomacy and policy, but from an investor perspective, if you are setting up projects in line with a national policy and then allowing investors to aggregate those projects, it just makes it much more investable for basically the landscape of investors, which is to say, depending on where you are with the stage of that project, you can bring in catalytic investors really early on, but later you can bring in the huge asset managers that can only invest in something that's like $1 billion size deal, but you need to aggregate those projects up. So,
I'd love to just quickly add, I mean, I think like it's when we think about some of the investors in our network who are coming in the really early stages, and sort of the costs of setting that up, right? The cost of even setting up a fund that invests in those projects and then those companies as well. It's like trying to really strike a balance so that you're not, so that you encourage impact washing or greenwashing, right? But that you are kind of leaning on that free market, making sure it's not too expensive to start up those projects. When you think about like the Community Reinvestment Act in the United States or the SBIC program, which has enabled a lot of fantastic funds to grow and pursue things like employee ownership strategies and so on, right? So kind of striking that balance and making sure that you're not falling into that trap of assuming that impact has to be solely something that's, lives in the world of philanthropy, right, or sort of CSR, right, which we think of as more of an outmoded or outdated at this point, but that, you can actually back and incentivize the creation of businesses and investors in those businesses that are delivering that double bottom line or triple bottom line, and giving them the appropriate guardrails, but not kind of overreaching there and making it too burdensome to do it well.
I can just
Pointed follow-up question, maybe, sorry. So might one thing India can do that the US currently isn't? Policy certainty, right? You don't have to wake up in Delhi fearing that somebody tweeted at 4 a.m. that everything just changed.
such that you can allocate capital with confidence.
Yes.
exactly what I was going to say. Two things so we investors are a skittish breed, and there are two things we like: stability and clarity. Give us stability and clarity, and that's how we can deploy our capital.
So Modi tweets, but he doesn't tweet. Okay. No. Who has more followers?
I mean, obviously because we have like 1.5 million people.
Fair enough. And we have time for one, maybe two more questions, I believe.
Can I go? Yeah, okay.
Oh, okay.
Hi, my name is Shiva. I'm pursuing my master's in sustainability management. And with the special crackdown on regulatory markets, on investments, climate tech investments, do you see more flow in the unregulated private markets in terms of institutional investors or family offices or high net worth investors? Or is the money also going out of US? Are people saying, no, I'm done with US, I'm going to take my fund outside? Is that happening? What's happening to the flow in the unregulated market?
I'd be curious what Marieke says, because she's more deeply embedded in the private markets. I'll say at a portfolio level, we're unfortunately seeing less investment among our client base in the private markets. And that is really driven by the fact that markets as a whole, we all remember what happened to markets in Q1 of this year. Like, markets as a whole are volatile right now. And in moments of volatility, a lot of people are scared of putting capital into illiquid investments. Ironically, what we all learn in business school is this is exactly the moment when there's opportunity in illiquid markets and to be putting their capital in, and some folks are savvy to that, but there's just a behavioral component that's making people a little bit scared right now. And so I'm finding folks are much more cautious about capital lockup. They want liquidity, they want security, especially because, by the way, the other thing we really haven't talked about much is interest rates. Like, fixed income is so attractive right now for so many people. And so they're like, why would I buy anything other than just fixed income right now? In a world where it gives me a little bit of security, it gets me my 5.5%, and I just want to sit on that till the world calms down. I don't think that's necessarily the best investment decision, but it's what we're seeing happen. Please tell me you're seeing something else.
I mean, I think it's mixed, right? I mean, I think there's, yeah, I mean, I would say policy and regulatory uncertainty and lack of liquidity have, I mean, we do need the liquidity, right? So we need exits, and people are not kind of going back and recommitting or re-upping, right, with the fund until they're seeing that. And so I think that the silver lining maybe is, or a necessary outcome of that is that people are getting a little more creative in what they're doing, right? So how are they, like the secondaries market is changing, and impact investing, we're seeing that, right? Or people finally beginning to sort of little, maybe we'll take a discount, right? Take off a piece of a portfolio and just try to generate some liquidity that way. And we also see things like the All Aboard Coalition, right? Where it's a group of big climate investors coming, and they're saying like, we will automatically co-invest if any of our very worthy, fund manager members, if 3 of them are invested in a project, and up to 45 million is unlocked via this fund, right, that they've created. And so that kind of creates, like, that's a nice creative second channel or mechanism for some of these exciting projects to start moving, growing, and hopefully finally exit. But yeah, family offices are definitely out front, but it's still, again, impact climate funds are not immune from some of the same fundraising pressures or macro challenges that we're seeing in the non-impact parts of the market. So we also shouldn't hold them to that double standard either, but that's where we're at.
Well, I was going to say, the U.S. as a safe haven got a little bit of a shakeup this year. And so I sat on a panel with a few climate PE impact investors where they were really focused on FX, so looking at currency. And because of that, emerging markets were kind of having a bit of a bump. So opportunities in emerging markets, I think this is a great time to look at them.
Yep. And credit as well.
Oh my gosh, yes, credit. Bit of a boom.
Moderator's prerogative, I get to ask the very final question. One piece of advice, and I'm not asking for stock picking advice, right? Or here's the technology, although we need it as academic economists. One piece of policy, right? One piece of, like, you're looking at the long run. Yes, lots of uncertainty right now, but what should we focus on? What matters? And is there a role for policy in the idealized way? What's your favorite policy to make that happen? Preeti.
Oh, I was hoping I'd go last. My one piece of advice, which is not super policy related, but is my genuine one piece of advice, is keep an eye on unit economics. I think part of what went sideways in our space, very candidly, over the last couple of years is when the markets got frothy, when everybody wanted in on the clean tech revolution, folks forgot about their investing fundamentals. And so they got really wrapped up in a vision and a hope. And this space is not actually kittens and unicorns, it's still investing. And so think about your unit economics, think about your finances, think about your timeline. All of those investing fundamentals, I think, serve you very well in this space. And from a policy perspective, I guess I'll braid this in. Even thinking about just as a cold-hearted capitalist, subsidy can be a part of the conversation. Find me a sector that doesn't thrive on subsidy. Healthcare, traditional energy, these are all sectors that also have subsidy. I think sometimes our space gets a little bit like self-conscious, like, ooh, there's subsidy involved. There's subsidy everywhere. And so embrace that. That is part of traditional investing. And as you bring the rigor of traditional investing into the space, keep in mind subsidy can be an appropriate tool in the toolkit. That's okay as well.
For me, I think I would lean into, from a corporate's perspective, and then I'll talk about it from an investor perspective. I had mentioned this before, this idea from a corporate's perspective, lean into decarbonization, particularly in hard-to-abate sectors. If it's material to your industry, your operational decarbonization, think of it for your corporate strategy, think of it for your M&A transactions, talk to your bankers about that. But then also CFOs need to get on board, and this is where I would argue there's a lot of lacking beyond commodities trading. Think of it strategically as you think of your carbon price exposure. I think from an investor's perspective, A few years back, I did a paper called Decarbonizing Everything, where we tried to understand how to get more juice, get more performance, and get more environmental outcomes from decarbonization strategies. This can all be incorporated into that. And that was a listed equities paper, but it was all about testing the merit and applicability of environmental data and then continuing to get more from it. So from an investor's perspective, particularly with asset owners, that's the discussion, because you're thinking of it, across your holdings. And then from a corporate perspective, you really need to kind of up your game if you're talking about net zero and you kind of want to be in this play. At this point, folks need to get more sophisticated and will perform better.
Marieke, final word.
Wow, that's a lot of pressure. I mean, I want to go back to something that actually I think that Preeti, you mentioned like the very top of the conversation, which had to do with time horizon, I think, right? And so, yes, exercise your, prudent, your care, make sure you're looking at fiduciary duty, but everything starts to make sense, and the calculus and the unit economics all sort of starts to change and fall into place when you just stretch your time horizon out a little bit longer. And so I don't know, what the role of policy is in that, but you look at groups like for the long term or long-term stock exchange or sort of some of these things, right? Or even your point, Bridget, earlier around, well, this may be moving to, in the listed equity space, moving away from quarterly reporting, and right? Maybe that's actually not a bad, maybe there's a silver lining there too, in terms of, the short-termism that sometimes we see in that space. So time horizon, I'm just putting that out there. But
In the end, it is the tragedy of the horizon, to paraphrase, or directly quote, politician in the 51st state, too soon? Preeti, Bridget, Marieke, thank you.